Okay, it looks like it's 5 o'clock. We'll call the Administration Committee meeting for September 13th, 2022 to order. Roll call, please.
Chair Cook,
Present.
Vice Chair Counter,
Present.
Supervisor Long,
Here.
Supervisor Fiedler,
Here.
Supervisor Burning.
Present.
We have a quorum.
Thank you. Our next item is approval of the minutes from Tuesday, August 9th, 2022. Those were in your packet. Any updates on the minutes? Supervisor Long.
Just a very minor technicality on page 3 of the packet. There was a motion to postpone until this meeting the discussion on the library agreement, and I think that there isn't really anything to discuss on that agreement, but since there was a motion to have it on today's agenda and it's not on the agenda, I thought maybe just a quick clarification might be in order.
Yes, thank you, Supervisor Long. That's right, that's correct. We had a motion based on what has happened, the activity since that time, relevant to our resolution that we were discussing, and per conversation with Administrator Witt, we did not add it to the agenda this time, but definitely can be added back to the agenda should we have new information in the future if someone requests it. Any other comments on the minutes? All right, then we'll move to public comment. I have a couple here. The first one, Annette Massey.
Good evening. Policy 2.4 returns to your committee for review. I greatly appreciate that our county board members have gone on record showing their support for employee benefits. It shows purposeful intent that you wish to preserve employer trust, which has been of concern to many employees. I thank you in advance for your thoughtful consideration of the latest proposed policy before you tonight. As a member of Staff Advisory, I am optimistic the proposal will be well received, and I look forward to reviewing this with my fellow committee members. The most important proposed change to this policy can be found in 2.4.9. It notes that existing employees retiring in good standing will be grandfathered to a cash equivalent of their unused long-term sick bank hours at their latest rate of pay, deposited into a retirement health savings account. In addition, the proposed change continues to allow a vehicle for employees' earned but unused PTO hours to roll to their long-term sick bank, a fundamental concern that Lieutenant Coleman has emphasized in his previous public comments. Thank you for retaining this crucial component to the policy. One clarification point for me is understanding the funding resolution agenda item in your packet. Why would we need a fund transfer if Retirement Health Savings Fund is not currently in a deficit? Also, keep in mind that not all retirement eligible employees will exit tomorrow. Although a fund transfer seems intimidating, it is essential to remember that a reallocation of fund balances has no direct financial impact, as they, more importantly, indicate a realignment of fiscal priorities and resources. In closing, I would like to thank you for your willingness to review the latest proposal to the Policy 2.4 and your sincerity in working together to find a common ground. Resoundingly, you are sending a message to employees that you are genuine in preserving employer trust. I encourage you to approve the proposed 2.4 policy. I also thank you for your commitment to realigning fiscal priorities and resources that directly affect your employees who faithfully serve all of St. Croix County citizens. Thank you.
Thank you. Next up, public comment, Lieutenant Coleman.
All right. Good evening. I'm excited to be back. A little bit less nervous this time. I know that kicking this issue back to this committee is creating a lot of work for many, especially Administrator Witt. I thank you all for taking a better look at this policy change and your diligence in finding a viable alternative for the betterment of the citizens, the county budget, and of course, the county employees. I believe everyone's in agreement the current policy is not sustainable. I believe that we agree that those who were promised their hard work and dedication and bank their hours in long-term sick bank deserve those hours. It leaves us with where do we go from here? I believe the county board sent back this policy to your committee to find that answer. We know that we need to change course, but how do we do this without crippling our budgets while retaining and recruiting high-quality employees that our county has come to know and expect? It was noted in prior meetings that long-term sick bank was not the vehicle for people to bank up hours to save up for retirement. And Ed already brought it up. I'm not going to reiterate the language that was drafted in 2009. We're all well aware that it was a vehicle for people to bank their hours for a retirement health savings account. So that's where my, request on behalf of many employees that I'm representing is that find that alternative vehicle, find that retirement health savings account that we can bank on and that you guys don't have to rely upon year after year the budget. Allow us to roll over more hours of our PTO instead of into a long-term sick bank that would create a 50% payout or ultimately a 25% payout. No one's going to invest their hard work, their time, their wages into a 25% payout. Give us that ability year after year to remove from your budget constraints the ability for us to put that into a health savings account that we can control and that we can invest into. Again, I appreciate your guys' time that it was kicked back down to your committee, and I hope that the hard work benefits not only the citizens and the county board, but also the employees that you guys oversee. Thank you.
Thank you. Is there any other public comment? Any other public comment? Any other public comment? All right, seeing none, we'll move on to our business items. The first item is the financial report, for August 2022.
The financial report is in your packet. I'm not going to go over it in any great detail. We'll sort of be seeing some of these same numbers when we look at the budget part of it. I'll jump down to the end of the report, though, and highlight the sales tax, vehicle registration fees. We're on target, right on target for vehicle registration fees. And sales tax, last 3 months have been really good. We've been exceeding $1 million per month for the last 3 months. So that's the first time we've had 3 back-to-back months over $1 million. So sales tax remains strong. So no signs of a recession in St. Croix County as of yet. The last 2 pages then are capital projects, where you can take a look at where the projects are currently. Not many of them closed out yet, but we're working on getting some of these projects wrapped up now as we get towards the end of the year. And then the ARPA projects, a lot of these do go through 2024, although we've been able to close out just a few of them that were shorter term projects. Are there any questions, though, on the financial report that I'd be happy to answer?
It doesn't look like it. All right. We'll move on to our next agenda item, consideration of tax deed bids. I believe, Christine, you're going to walk us through this.
Good evening, everyone. So in your packets, on page 36, or starting on page 34, is the information regarding a tax deed property that was taken by judgment February 2nd of 2022. In July, the owner of an adjoining property contacted my office to discuss purchasing the property. So by statute, we did publish for 3 consecutive weeks, July 21st, the 28th, and the 4th of August, the notice to sale with the minimum bid, asking for a minimum bid of $325 to be brought to our office by the 12th, sealed. And today, the tax deed committee met and opened our one bid that we received, and it was a bid for $500 from the adjoining property owner. You can't really tell on this photo, but on the next one, it's a little bit clearer where this little strip is. It's the one that's outlined in red. The gentleman that contacted me is the owner of the property just above it. He indicated to me that he was also purchasing the property that's right next to it as well. I'm not sure if he's done that, but he did indicate that, and he is the person who placed the bid, so I'm just bringing that bid of $500 to you this evening for approval.
All right, thank you. Supervisor Cowan.
On the aerial map, do you know approximately where that strip is?
I don't know. I don't know where it is. I looked at it a little bit today and thought there's no heads or tail. I can't tell where it is in that aerial photo of it. I just know from the next following picture where it is. That picture, the aerial photo was before I was here. If I was here, maybe when it came into record, I might know more. And Denise wasn't here today to discuss it with her.
I think it runs right along here. There's a bit of a jut out at the bottom of that next one, which I guess this looks like it might be the jut out.
Sure.
So my guess would be it runs right along this field here. That's my best guess, though. I'm not that familiar with it myself.
Okay. Then with that, just clarification that there isn't any easements or anything in there for utility easements or municipal easements of any type, drainage easements that would be a purpose.
I don't think so. Heather, do you remember any?
I don't believe there are on that little strip of land.
Okay. That's all.
Any other questions?
Supervisor Long.
So I'm just kind of curious, I don't think you'll know this, Christine, but how did we end up with this little strip of piece of property?
Well, I think
how can that happen?
I think it just didn't get, when Heather, correct me if I'm wrong, but on the original map, it didn't get included. And then at some point, it got noticed that this little strip got left out, and it was offered to adjacent property owners because it just basically has no owner. It wasn't mapped properly. Am I saying that correct, Heather?
Yes, I believe, so the former owners were Matthew and Catherine Rowley, Rolli, and it's just a little strip of land, and so they didn't pay their taxes on it for 3 years. So then we took it under the tax deed process, and it's not worth anything unless you own the adjacent or adjoining properties, and so it just sits in limbo, and the county owns it until we can find an owner. And so when the gentleman contacted Ms. Hines to discuss it, then we published it for sale. And you'll see we will have a lot of these little strips of lands or outlots that we'll be taking through the tax deed process that will be coming before you, and we hope to publish them on a website to sell them and hopefully get rid of them or allow the municipalities to purchase them. But in this case, the property owners didn't pay their taxes on it for 3 years, so we took it.
All right, any other questions? So you are looking for a motion to approve the bid, correct? Sure.
Yep.
Is there a motion? Supervisor Cowner? Is there a second?
I'll second.
Supervisor Long? Motion and second, all in favor? Aye. Aye. Opposed? Motion's carried.
Thank you.
And I think our next agenda item, consideration of mandated discretionary services for the county clerk, is yours as well.
Okay, so on page 39 and 40 of your packet, you'll find the county clerk's mandated service spreadsheet. I have listed there the service. I mean, it's the standard that you've seen from everybody else, whether it's mandated or not, the description, and then the information that I added to it was the priority level, the service level, the expense, the funding, and any comments that I had regarding those. I'm not sure if everybody had a chance to look through it, but I added whether it was a high, low, medium priority, and then the brief description and expense and funding information. I'm not sure if everybody got a chance to look at it. If anybody has any questions, I'd be happy to answer.
Supervisor Long.
I was curious if the, regarding work permits, have we tried to contact Hudson School District to see if they'd be willing to take that over? It just seems something that we can kind of get rid of, that everybody else, all the other high schools do it, so.
I don't know if they have in the past, but with support, would probably go down the road to contact them to see if they'd be willing to do it. I mean, the students are right there on site. It's a little easier. They can go into the administrator offices in the summer to get it done through them. I'm not sure why Hudson does not do them. I don't know when it stopped. It seemed like when I was at a court level, they did do them. I'm not sure what changed, but I would be willing to reach out to them to discuss them taking that over. We certainly spend more money in work hours and paper than we bring in from it. And there's liability too, where we don't really, we're not, there's a little bit of liability that's, my staff is concerned about with, you know, how much information that we're getting that the student is truly, or the youth is doing at these jobs, and for the amount of what we put into it and get out of it, that liability is a little straining, a little worrisome.
Other questions? No?
Okay.
All right.
Thank you. Have a good
Thank you.
evening.
All right, our next item, resolution amending personnel policy. Ken?
Yeah, I'll take that one. So this was referred back from the county board. So based upon the feedback from the county board, I made a little bit of a sharp turn on the policy recommendation. So there's some pluses and minuses to the new policy recommendation. Basically what I'm doing though is I'm just grandfathering all the existing employees into the current payout. So 100% payout on all the hours they have at their final rate of pay. And then no payout for any employees hired after the implementation date of this. So that's where the plus side of it is that it has a lower future cost after everyone's grandfathered off. There's zero payout compared to a continued payout under the other proposal, which is actually more similar to what a lot of our peer counties had done like 10 years ago. The negative side of it, though, is it does have a higher fiscal impact for us in the short term. So if you look at our trajectory of payouts, they've been going up over the past 4 or 5 years. That's going to continue until it crests at some point within the next decade, and then it'll decline and eventually zero out. So it's a different approach, but based upon the feedback from the county board, this is the new approach that I think 19 supervisors will vote for. I have kind of a hard job guessing what 19 people want, but this also then provides for what Chuck was talking about is another vehicle. So this would give us time then to create that HSA, and it really takes time to build up balances in the HSA. That's what new employees hired after implementation would have available. We're looking at implementing an HSA in 2024. So that's a little ways out and years to build that up. So current employees have a different vehicle right now. Future employees will have that vehicle in the future, and anyone hired just recently might get 2 vehicles. So.
All right, discussion. Supervisor Long.
Why do I always feel like I'm the one that asks questions? So you mentioned that, of course, one of the negative aspects of this is the impact on the fiscal situation of the county. So, I'm actually in favor of making this change. I like what we're doing, and I think it's important to honor the feedback of the employees that we're getting, and that's really important. But I do think it is also important at least to identify here's what it's going to cost by making this change, just so that everybody's aware the impact on the financial situation of the county going forward.
Yeah, It's hard to know the exact costs because I don't know how many employees are going to stay till retirement, what those balances might be, where the wage rates are going to go over the next 20 years. So there's a lot of variables involved in it. What I do know is that I can't put enough tax levy dollars every year into the RHS fund to cover it. I would have to gut other portions of the budget to put hundreds of thousands more into that. So the only way that we really can, and I think Supervisor Cook had asked this question at the county board, what are our other funding options? Well, the other funding option is we can transfer fund balance into it, and that's the next item on the agenda. So that's the other way that we can fund this. And so if you approve this recommendation, that's why the fund balance on the next item is structured the way it is. So the consequence of that, though, is that that fund balance money is going to go into an RHS fund, and it's not going to go into, where I would have preferred it to go, into the capital improvement fund. Capital improvement fund means reduce future borrowing costs, which have a fiscal impact for the taxpayers. So how much money gets reallocated from the unassigned fund balance into the RHS fund over the next 20 years? I don't know. At the current rate, it could be $10 million, though. So that's the fiscal impact, but that's a decision that the county board is making about how we use our funds.
Other questions? Supervisor Long.
So given the fiscal impact, are there other options or other alternatives that we might consider to lessen the fiscal impact while still trying to honor the our commitment to our employees as much as possible?
No.
Okay.
I mean, really, the point is if you feel that the employees that we have that are sitting in the audience here were promised this and you want to honor that, there's no legal requirement to it. Corporation counsel will tell you you don't have to legally do this. But if you want to, and my job is not to do what I want to do, my job is to do what 19 elected officials want to do. So I'm trying to guess that right now, reading your faces. But if you want to honor that, this is the vehicle to do that. So there's no way to put in a cap, put in a limitation, put in a dollar limit that doesn't restrict. And so restriction is what we've been hearing. They don't want to be restricted on this. This was something that they're planning for and have been planning for a while. So they want to be able to use that the way that they've been planning to use it. Now, any future employees, that's going to be different. They're not going to have that option to use this as part of their plan. We're going to create a new HSA option for them to save for retirement. But for the current employees, I don't see a compromised position that saves us money and honors the promise that the employees feel they were made.
Ken, I have a quick question, and this might be more applicable for the next item, but how do you determine the amount that you want to transfer each year on the process? Because don't always know how many people are going to retire necessarily, or...
Yeah, peeking ahead at the next item, I've recommended out of the $3.8 million fund balance that we have available to transfer $2 million into the RHS fund. So I've recommended the $2 million, which I think will last us about 4 to 5 years, because I know what the 2023 budget is going to look like. Some structural changes that I'm making to that budget, they may reduce future surplus amounts. So I'm trying to get a little bit ahead now that we have a fairly large one this year, the 3.8 million, so that I don't get into a pinch and a bind and back here in 2 years saying, okay, well, I don't have any surplus to put in here and it's out of money. So I'm building up a little bit of a cushion for myself to maybe make it through some lean years, especially if the economy does turn into a recession and sales tax numbers come down. I showed you, they've been strong just recently, but a recession will affect our sales tax, and our sales tax is one of the biggest contributors to our annual surplus amounts.
All right, thanks. Any other questions? Oh, Supervisor Burning.
So we budget for full salary and benefits for every employee position, correct?
Yes.
Okay, so if an employee doesn't take time off, we still have that money budgeted, correct?
No. So we budget for 2,080 hours per year for an employee. So whether that hour is worked or that hour is taken as PTO, it's budgeted. So, so generally speaking, we've budgeted only for the 2,080 hours. So on a separation, if you separate on December 31st, you've worked your whole 2,080 hours, plus you're going to get a PTO payout, plus you get an LTSB payout. Those are actually dollar amounts above and
So
beyond
PTO
that we
is
do
up-
not budget for.
PTO is beyond the 2080 then,
Correct.
and we don't budget for that.
Correct. But nobody takes, other than on a separation, nobody can get more than the 2,080 hours. We budget
Right.
overtime separately, but I
But that's what I'm
guess-
getting at. If we have 4 weeks where they would have taken off, we would have paid them anyway, correct? So if they would have taken 280 hours of PTO, they still would have gotten a paycheck into their checking account. Am I right?
Yes.
Okay, but then they
Yeah.
don't take that 4 weeks of PTO. We still pay them for 280 hours. Or,
Yeah, 2,080 hours. So they're
Yeah.
either working it though, or they're taking it as PTO.
Right.
So there's a fixed amount that we're going to give to the employee in any year, and that's what we budget for. So what
all
that
right, 2
ratio
plus 2 equals
is-
4 now, I got it.
Yeah, what that ratio is different for every employee.
Yep.
But there's no additional budgeting for earned PTO. We do have a liability in our balance sheet. Those are unfunded liabilities, though, for future expenses.
Okay, any other questions? Supervisor Counter.
Just so I'm understanding, so you said it'll, so for about the next 10 years, we're looking at about $10 million. Is that correct?
No, not, I think the 10 million would be over the next 20 to 25 years.
About 2025?
Yeah, so I think it's going to be escalating in annual expenses over the next 10 years, and at some point right around there, I think it'll probably peak, and that number will start to decline.
Just to make it simple, if we were to flatline that at an average for the 20 years at $10 million, what would, on an annual basis, how's that? Again, this is just to try to figure out where this is going, but how would that amount affect on the mill rate if we were looking at it, that there were no other way to fund it?
Yeah, so it's 500,000 a year is the estimate that I'm using on average over the next 20 years of what I think it'll cost, above and beyond what I'm levying currently. So that 500,000 though, the issue is I can't levy it. So I have to cut somewhere else out of the budget. I would have to cut $500,000 out of the budget somewhere else in order to fund it. So what the impact on the mill rate is, it's not a large dollar amount. It's a very, very small part of the mill rate if you wanted to look at it at a cost per thousand. But it's not feasible to add it to the mill rate.
No, I understand.
Yeah, a little bit of a futile exercise to calculate it, but it's not possible.
Right. No, I was just looking at it from an aspect, that's what I was trying to get at, that I didn't think it was going to be at 500,000
Yeah, very
compared to
small.
what we spend as as the county as a whole, that it's not going to be very much.
Any other questions or comments? No? If not, is there a motion?
I don't know, am I closer on this idea? I mean,
I
trying to read the faces, but you guys are like really playing your poker faces
I will
tonight.
make a motion to approve the resolution amending personnel policy. Second. All right, second. Motion and second. Any other discussion? All in favor? Aye. Opposed? Motion's carried. Thank you.
Is the county board going to adopt this one then? You think this is,
We don't
this is
know.
easier
No
to
guarantees,
understand?
Ken.
I don't know.
All right.
You guys are killing me.
All right, our next item, resolution authorizing fund balance transfer. We just kind of had a preview of this.
Yeah, so fun with charts and graphs. So let me make this just a little bit bigger so you guys can see it. So first off, the general fund. So every year after the audit's done, we go over the fund balance of the different funds and sort of measure where they're at. We have a fund balance policy that dictates where they're supposed to be. The general fund, for example, is supposed to be at 35% of our expenditures plus or minus 3%. It sort of gives us a range. And that's what you see with these orange lines. These are the range that we expect the fund balance to be in. So when we're over, that means that we're in excess of our fund balance. That's a good thing. We have more cash on hand than we say we should be maintaining at a minimum. So this amount of overage right here is $3.8 million and some loose change. So that's the part that we have the ability to reallocate then. So just going over quickly the other fund balances then. Health and Human Services, you'll see that they jumped up outside of their range. Part of that is COVID monies that's come in, so I expect that to actually drop back down in the next year, so I wouldn't get too excited about that overage at this point in time. The Highway Department, you can see that 3 years ago, they jumped up and are exceeding their range. They're an enterprise fund, and so they operate more like a business, but as such, they're less of a cash flow type fund as a lot of our other funds, and they end up with book value assets. And so the $27 million highway facility has a contributed capital, which is really where this came from. So we might want to actually look at what our fund balance policy is, or some different way of looking at this, because Robbie keeps wanting to spend all this money. So we need to do something to reflect that. I keep telling him, no, it's not real money, it's just book money. So, yeah. On the Health Center Fund, you can see that they actually jumped from a negative fund balance to a positive fund balance. I wouldn't get overly excited about that one either, because again, that's a COVID-related revenue source that they booked in last year, and it's likely actually to dip back down this next year. So some of these, you kind of have to take into account the circumstances that we're under, and a one-year anomaly, don't get too excited over. The RHS fund, so we did a large cash infusion. We closed out the HRA fund and had moved a large sum of money in. You can see that quickly depleted. We're going to be down real close to zero by the end of this year. And so that's why I'm recommending additional transfers in. I want to build it up and we'll draw it back down over a number of years, rather than ending up in a negative fund balance situation like we have with some of the other ones. Health Insurance Fund, they have a 25% target. You can see the steep incline of that. That's matching expenditures. So health insurance expenditures are going up rapidly. We had kind of a bad year, so we ended up drawing about $1 million down out of that fund balance. We actually ended up below our target. So that's something to be cautious of. That's not COVID related at all. That's just, we're self-funded, and you have good years and you have bad years. So we're going to need to watch that and make sure that that's not a continuing trend. Hopefully that's just a one-year anomaly that was bad news. Back here in 2010 and 11, they were actually drawing money out of the health insurance fund and using it elsewhere. So they corrected that, and the fund balance built up, and we've actually been fairly steady for a number of years since then. On our workers' compensation fund over here, that's a self-funded for work comp claims. It has good years and bad years. We had a good year, so we actually popped up to meet our fund balance. And then on the liability fund, we're self-funded there too. That trend line continues. We've actually been really quite stable over the past 3 to 4 years, but we have a nice healthy surplus built up in our liability fund. So are there any questions about the funds? And then I'll get into the fund balance transfer recommendation.
Supervisor Long?
On the health center fund balance, I mean, just from a graph standpoint, that looks alarming. So, is it?
Yep.
Would you like to elaborate a little bit?
So the health center, and back here where they were actually positive, it was because of cash transfers in. So the health and center really struggles to be self-sufficient. Over the past couple of years, if you look from about 2016 on, that line has gotten better because their operating revenues have been exceeding their operating expenses. I mean, it's micro amounts really in comparison to where they are. I've just kind of been holding the line saying, I'm not going to transfer money in. You need to dig yourself out of this hole. And I expect them eventually to do that. If you remember the WIPFLE projections back in 2015, they said that they were going to make enough money that that was going to happen. So I've just been waiting for it to happen. WIPFLE couldn't have been wrong. So, I mean, that's where it's at. It's really just a little bit of stubbornness on my part of not wanting to transfer that in, waiting for that to come back, and it's happening slower than what WIPFLE had said it was going to happen. But it is actually trending in the right direction. And again, the health center does not take into account any of the debt service fund. That's paid by debt service, not by the health center. Asterisk disclaimer.
Supervisor Counter?
Relating to the health center fund balance too, do we see, will it be of any help with the program that we're looking at? Will that help at least move it a little bit in a positive direction from the Kitty Road Center conversion?
No, it would not.
It's going to pretty much
Yeah,
stay
that
flat.
project, which I think is dead in the water now, by the way, but
Shoot.
was really cost neutral for the health center. It wasn't going to generate any additional revenues. And that wing, it's really a staffing issue of why they're not opening it up. So it's kind of a little bit of a dead space for us at this point in time. Hopefully we can do something at some point, but I think it's going to boil down to getting enough staff to be able to open that wing. That would help that bottom line.
Then with that also, now, in the numbers, when you're doing that, is that calculating the depreciation of the building and all that, or is this just basically cost and expenses?
The depreciation, everything is built in there. The depreciation and some of their other adjustments, though, are fairly close to neutral on there. They end up being within 100,000, 200,000. So they're fairly minimal. So those are built into that formula. But we try to look at it, I try to look at it anyways from a cash flow perspective. I try to pull those book values out and look at operating revenue versus operating expenses. And they have been, over the past few years, doing okay looking at those numbers.
All right. Thank you.
Any other questions or discussion?
We can get into the resolution then. Oh, that's the wrong way. Yeah. So the resolution then is transferring the $3.8 million from the unassigned fund balance, $1 million to the KIP, $800,000 to the debt service fund, and $2 million to the RHS fund. So the $2 million, it's an arbitrary amount, just kind of picked that dollar amount. I think that'll buy us in that 4 to 5 year range, though. So that's kind of what I was looking at without totally putting nothing into the KIP. I mean, we could have moved $3 million in and gotten 6 years, but you know, I just picked a dollar amount. You guys can change it to whatever you like. But that's the reasoning of why that, I think that'll get us through any recession type impacts that we may have. So I don't run into a point where I don't have money to transfer in the future when it becomes negative. The KIP then gets $1 million, and which is basically the leftover amount. The $800,000 that goes into the debt service fund, and as you put up here, I could have called it the Fiedler clause. but it covers the negative fund balance that we have, and it provides the county administrator with tools, the Fiedler tools, to help reduce the tax levy. This is something Supervisor Fiedler has talked to me on several occasions about being able to do, so.
All right. Any other questions? If not, do we have a motion?
I'll move to approve.
This motion by Supervisor Long, second by Supervisor Counter. Any other discussion? If not, all in favor, say aye. Aye. Opposed? Motion's carried. Okay, item number 6, consideration of 2023 budget requests. Ken?
All right, we're going to take a little bit of time to go through each of the budgets so you know where they are for the departmental request. I've been working through and I'm getting close to finalizing the total budget. We'll go over the county administrator recommended budget at the August 5th Committee of the Whole. Yes, October 5th, yeah, sorry. At the October 5th Committee of the Whole. So when we summed up all of the budget requests, though, compared to the revenue expectations that I have, taking into consideration our levy limit, even though we were the 4th highest net new construction, which provides us with a fairly substantial levy limit increase, we still ended up with $1 million in expenses in excess of where our revenues are going to be. So out of all of the budget requests that I have on here, I do have to cut $1 million from all of these requests. So I have a list of what those are going to be. The purpose of these meetings in September is to get your input, though, to say, I really like the change that they've made here. I want to make sure that you keep that in there, or why are they putting that in there? I totally disagree with, the direction that this department is going. Let me know now, because that'll go into my prioritization of the cuts that I have to make. All right, so the first one up is Corporation Counsel. So when I read the budget, I look at the very first line to begin with, $633,879. That's the amount of tax levy that's needed in order to support this department. In comparison to last year, they were at $603,177. So they went up by $30,000. So the first thing I do is identify how much more tax money they need, because that's the area that I have the most flexibility over, or really the biggest limitation that I have. So I have to take a look at that. So they wanted 30,000 more. So the next thing I look at then is I drop down to look at where were their net wages and fringes. They were at 580,000 last year, and this year they're at 610,000. All right, that's 30,000. That tells me right there everything was in wages and fringes. The department heads have no control over the wage and fringes. I set all those based upon formulas, basically. So those are all preset for the department heads. It's not a request that they made. That's really a calculation based upon their staff, the benefits that they take, and the wages that they make. I do have the 1.4% health insurance increase factored in here. That's what the administration committee had approved for our health insurance plan changes. That's in there. I do have a 3% COLA to the wage grid in here, and a step increase. So the average employee will see anywhere from 4.5% to 5.5% increase. So 5% on average is what the employees will receive for a compensation increase. And considering the CPI number today that went up another 1/10% instead of declining and sent the market into turmoil over a 1/10% CPI. I think that's a tangent, but we'll go on. That's why I have that compensation increase in the budget, though. So we're trying to at least offset some of that cost of living increase that the employees are experiencing with as much as I can possibly afford in the budget, and that's part of the priorities that the county board had for me. It was number 2 on the list after fixing any structural deficits that we have, which we will fix with this budget. So 5% employee increase, very limited on benefits, and very small changes there. The next thing that I do look at then is I drop down to the end of their operating expenses, and since we know that their whole change came in the wages and fringes, you can see that they went from 24,000 to 25,000 on operating expenses. That's the part that the department head has control over. And so for a $1,000 change, I'm probably not going to spend a whole lot of time going over those details. I have $1 million to cut. The $1,000 Heather's spending is not going to do me much good. And so that's how I look at the budgets. I'm going to go through each one now a little bit faster, but if you have questions on any of the individual budgets, please stop me and let me know. So the county administrator's budget went from 432 to 491, so we got about $60,000 there. So we're going to drop down and we're going to look at wages and fringes. That's up by $60,000. Really, one of the big changes was $28,000 in health insurance. So we had a 1.4% increase in health insurance. So why did it go up by $28,000? Well, that's the difference between an employee that elected not to take health insurance to an employee that takes a family plan. So when you have a small department and there's a difference in health insurance plan selections, it can have a large impact on the budget. So there's a huge increase right there. Then we'll take a look at where the operating expenses are, 88,000 to 88,000. So there was virtually no change in the operating expense part. It was all on the wage and fringe side. Unallocated, this is other federal payments. This was the broadband grant money that you're seeing on there. And so we're just carrying that over from the prior year because those grants will be paid out sometime over 23 or 24. The insurance fund, so we run our health insurance and our dental insurance through this. We've increased the amount of internal service fund transfers by a little bit. That's the amount that the employees are paying through contributions and the amount that the county pays through departmental charges for the health insurance plan selections. So out of our $120 million budget, about $11 million of it is going for insurance. So it makes up a big part of our budget. But again, that was a 1.4% increase over the prior year. HRA, I'm only showing this because it still had fiscal year 20 dollars in there. This is the $1,138,713. That was what was transferred out into the RHS fund. When you saw that blip on that chart where it went up, this is where that came from. Otherwise, we had eliminated our HRA in 2020, so this will drop off our charts next year. So the RHS fund, so we've gone from 150 to 200 up to $250,000. That's where my initial budget number is for that. We've had additional retirement payouts. This was as of August 4th. We'd paid out $448,000. It's gone up from there. So this is the fund that we've just talked about. And you can see the prior year's $579, $630,000. And so that's that upward trend that we're seeing. And we were at $450 at the beginning of August. And this is where I just don't have enough fiscal resources to put into this fund. So that's why we've spent so much time talking about it. So 1540, this is our liability insurance fund. We had shown that that fund is fairly healthy. It has been stable the last few years. We have been seeing double-digit increases in our premiums. Really, if you look at what's causing increases in liability, it's jury settlements. And so jury settlements over the past 5 years have dramatically changed related to officer-involved shootings. So usually juries, 10 years ago would have said, well, the officer uses best judgment and there wouldn't have been a large jury settlement. Nowadays, it's multi-million-dollar settlements or jury decisions, $10 million jury decisions when there's an officer-involved shooting. We're getting a lot more lawsuits over it. And so we're in the insurance pool, even though we haven't had any of those issues in St. Croix County, we're in the insurance pool with the rest of the United States. And when those costs goes up, it's spread out amongst all the people that insure for that type of coverage, because we may be the next one. And so they charge us more and more premiums every year. That's why we've been seeing double-digit increases, though, in insurance premiums. So that's the liability insurance fund. We also cover property insurance out of here, and a lot of these costs are related to property claims that we have, but liability is probably the bigger portion of that. Workers' compensation, this is driven based upon percentages off of salaries. We use 4 different work comp codes, each have a different rate that we charge to the different departments, and then we're self-funded for those claims up to $550,000. We have a reinsurance at that level. We've only hit that once, though, in the last decade. So basically, we just have claims that we pay out and the premium costs that we have. And last year was a good year, and this year's not doing too bad so far. Uh, 1110 is the county board. So this is where a lot of your expenses come in. If we look at the tax levy, it's flat. There was no increase budgeted for county board, per diem or reimbursements, so we're pretty flat on where those expenses are. Fund 1420 is the county clerk. She went from $197,000 up to $206,000 per year, so a small increase there. If we look at wages and fringes, you're seeing most of that increase is right there. When we drop down to operating expenses, there was about a $2,000 increase, so not a lot to see with the county clerk. Most of these budgets, other than when we get to gyms, are pretty benign. The big increases are coming in with the sheriff's office, HHS. That's where the big dollars are. You guys have some of the more boring routine stuff till we get to gyms. Yeah. The dog fund, that's an in and out fund. It's basically just accounting for dog license sales. Elections, this is cyclical every other year. You see 98,000, 43,000, 120,000. We're budgeting 89,000 next year. It's really just calculated based upon the number of elections that we have. And so it goes up and down every year. Human resources, so they went from 557 up to 622. So we're going to take a look at what is causing that. If we look at net wages and fringes, we went from 425 to 475. So they've had quite a bit of turnover within that department, and so people are making different amounts than what their predecessors were. A lot of that is attributed to that. A lot of times in the job market, we're hiring people, bringing them in higher than what the people exiting had been making. And that was one of the cases with this department, and that's where you end up seeing that reflected at. If we look at their operating expenses, they're up about $15,000. So that's a little bit more of a change. So then we go back and we take a look at, okay, so what was it that went up within that department? So you can see under consultants fees, they went from $15,000 to $20,000. They have this new purchase services, but they moved $25,000 out of other professional. They have other contractual services for $22,000. So these are the points then that when I sit down with the department heads, I go over, ask them what's in those amounts, and then take a very close look with my big pencil and cross some of these items off as we have to cut $1 million to get down to the final budget amounts. Yeah. Audrey says it's the wage study. That's what she has budgeted. So, yeah. All right, well, we'll only study 3/4 of the wages then. All right. 1450 is our information technology department. So they went from 2.5 million to 2.7 million. So that's up 190,000. So that's enough usually to catch my attention. So we'll jump down to wages and fringes. That's up about 70,000. So I still have 120,000 then, which I know is going to be within their operating expenses. And so sure enough, we see that software subscriptions and renewals is up. We see equipment on fixed assets. So the laptops that they're buying, those have increased in prices. The Oracle software that we buy has increased, the Microsoft licensing has increased. So these are all increases that we're seeing within the market. That's the inflation, our 8% CPI index. We're seeing that, and that's what you're going to see with the gym's budget too, and facilities. We are seeing those expenses in some areas. Our service-heavy areas, like HR, which is primarily service-heavy, other than, you know, the wage study that they're going to contract for, you don't see as much increase in their expenses. But inflation is hitting some of our budgets, like this one. So, to a large degree, there's just nothing we can do about it. If you're going to continue to use Microsoft, you're going to pay the price that they charge. 1510 is our finance budget, so they went from 596,000 to 639. So we'll take a look at their net wages and fringes. They went from 521 to 566, so bulk of their increase is right there within the wages and fringes. When you look at their operating expenses, then you can see they went from 95 to 93. She actually cut $2,000. Good job, Leah. So the default department is sort of a catch-all for things that don't fall within the jurisdiction of any one department. So the big one in there, though, is sales tax. So our 2020 actual sales tax was $9.8 million. Our 21 sales tax, which this is still not right,